Good afternoon, ladies and gentlemen. We're excited to begin the new year with our 2017 webinar series, kicking off with Options Fundamentals for the new year. For those who've joined us in 2016, you may notice a new voice. My name is Alexander Osinga, and I'm a new staff member here at the OIC. I'll be guiding you through today's webinar session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's webinar, we'll be discussing core options concepts that you should know cold, and how you can manage your portfolio's risk through the smart use of options. As always, we'll cover the material as well as your questions in a quick 60-minute session. Our instructors for today's webinar are OIC's very own Bill Ryan and Mark Bensequin, who are integral members of our Investor Services team. Bill has been involved in options industry for over 25 years, starting at a brokerage firm as a runner, margin clerk, and options trading desk manager before moving to OIC OCC, where he's been here for 16 years as part of the Investor Services team. Mark began his career in options nearly 20 years ago with Stafford Trading before transitioning to brokerage operations, where he spent most of his career in the trading pit, gaining special insight into the customer order flow and trained execution. Both Bill and Mark are certified OIC instructors, bringing a breadth of an options experience to the table. We're excited and proud to be featuring them in this year's webinar series. And now, ladies and gentlemen, Bill and Mark will bring you our topic today, Options Fundamentals for the New Year. Gentlemen?
Well, thank you, Alex. We appreciate the introduction. My name is Mark Bensequin, and with me in the OIC studios is my partner and good friend, Bill Ryan. Hello, Bill.
Hello, Mark. Thank you, Alex, for the kind words.
And ladies and gentlemen, thank you for joining us. As Alex had said, this is the first installment of our 2017 OIC webinar series, which we're very excited for. We're going to be mixing things up a little bit this year in terms of our content and our format. Alex had mentioned the Q&A button on your screen. The reason I bring it up is because for next week's webinar, we are going to be taking those questions. Those are going to form the basis of our presentation. We're going to be answering your questions and building a presentation around them. So please make sure that you submit your questions to us, some of which we'll get to today, some of which we'll follow up later in the week, and some of them we will, as I said, build our presentation around next week. So we're very excited for that. In terms of our presentation today, let's go ahead and get things started with some housekeeping, as our good friend Joe Burgoyne says. The Options Industry Council. As you know, options involve risks and may not be suitable for everyone. As a matter of fact, in order to trade options, your account needs to be approved by your broker to do so. Part of that approval process will come in the form of your acknowledgement of our risk disclosure document, the characteristics and risks of standardized options. That document is available here at the OIC via our optionseducation.org website or the OCC at theocc.com. You can also get a copy from your broker. Finally, we will be looking at, or I should say we will not be looking at commissions, fees, margins, things like that. Basically, we want to keep things simple. And even though these are fees and factors that occur in the real world and will impact your account, we want to keep things simple, and we won't be looking at those today. We also will be talking about uncovered call options, uncovered put options, what we call naked options. Those are some of the riskiest trades out there. The reason I mention it is I just want to add an additional disclaimer. If you're thinking about these, make sure you discuss it with your broker, as these are and can be very, as I said, they can be very risky, and we just want to make sure that everyone trades wisely. Speaking of trading wisely, who are we? We are the Options Industry Council. We are a not-for-profit organization whose sole purpose, whose sole agenda is to educate private investors, individual investors, financial advisors, and the like on trading options wisely. We want to make sure that everyone knows what they're doing and they have a good experience trading options, and they will spread the word, and the industry will increase by doing so. The OCC is our parent organization. They are the world's largest equity derivatives clearing organization, and they act as the counterparty for every options trade, the buyer to every seller, the seller to every buyer. They fund the OIC. In addition to the OCC, we receive funding from the various option exchanges. As you can see here, we've got about 6 left after the recent years of buyouts, mergers, and consolidations. But we've got the BATS and the BOX, as well as the CBOE, the MIAX exchange in Miami, and everyone knows the NYSE and the NASDAQ. Those option exchanges have experienced exponential growth over the last couple of years in terms of options volume, as you can see. With the advent of ETFs and electronic trading in the early 2000s, you can really see that explosive growth year over year until we get to where we are today. As a matter of fact, in 2016, we cleared options trading amounted to a little over 4 billion contracts. It was the 4th highest options traded year that we've had since the existence of options trading back in the early 70s. So now that that's out of the way, let's get right to our presentation. We're going to be talking about what options are, as well as the different types of options, calls and puts, the contract terms that are associated with options trading. We're going to be talking about some different concepts, exercise and assignment, as well as in, at, and out of the money. We're going to be talking about some different options pricing mechanisms, intrinsic value, extrinsic value, and we'll also talk about buying calls and puts, as well as selling calls and puts. Now, before we get started, as you know, if you've been joining us in the past, we like to do our polling questions. So let's go ahead and take a look at our first one. How often do you incorporate options into your investment portfolio? You can just go ahead and make a selection there. Do you trade often? Are you a frequent trader? Or do you just trade from time to time, usually having a position on, 1 or 2 at a time? Have you traded only a few times in the past, or are you brand new and have never traded options? Go ahead and make your selection, and we'll take a look at what we have. Oh, terrific. Well, it looks like we've got a lot of people new to options, which is perfect for our Options Fundamentals program. So I'm very excited to hear that. It looks like the rest of the categories are fairly even split, roughly 20% plus or minus. We do have a few frequent traders out there, so you guys should be the pros. So bear with us. Maybe we'll give you some information that you didn't know or present it a different way. But I'm very excited to see that the bulk of you out there are new to options trading. Speaking of which, let's go ahead and get into what an option is. The easiest way to understand something is to define it. And options, basically, in its most simple form, are contracts. Contracts have buyers and sellers. In the case of options contracts, buyers have rights and sellers have obligations. Now, those rights and obligations amount to buying or selling a specific underlying asset, whether it be stock, ETFs, or an index, but buying or selling a specific underlying asset at a specific price on or before a specific time. Again, the key points here are buyers have rights, sellers have obligations. Now, why do we trade options? Well, in a word, flexibility, right? Options give us, options give us choices. Options make it possible for us to meet a variety of our investment objectives. Risk reduction, right? We've got a position on already and we want to reduce that risk. We can buy a put. We want to generate some income. We can sell options. We can sell credit spreads. We can do a covered call, for example. Stock acquisition. We can sell puts, right? That's a different way to acquire stock, and Bill's going to be getting into that a little bit later on. But options offer us flexibility, and without them, well, this is what we're left with. If we were bullish on a stock, we can buy it. We can go long the stock. If we were bearish on a stock, we could sell that stock short. And that's really about it. We didn't have too many, options before options. Now, look at the flexibility that we have. We've got long calls, short calls. We've got long and short puts. Again, Bill will get into those a little bit later. But we've got straddles and strangles, and those are strategies that we can use to take advantage of big swings in the marketplace, whether it be up or down. We've got collars that we can put on to protect a stock position that we already have. Options give us flexibility, and also, forgive the pun, but options give us options. Now, when it comes to options, there are 2 basic options, and that's it. We've got calls and we've got puts. Bill, why don't you tell us about those?
Thank you, Mark. As you said, there are 2 option types, calls and puts. For options on an individual stock or equity or an ETF, the underlying asset that can be bought or sold is 100 shares of the underlying stock or 100 shares of the ETF. This is one of my favorite slides in this presentation. In one slide, we have just a terrific amount of information that is very helpful to the viewer. So if we look at this slide here, a long call holder has the right to buy 100 shares of the underlying stock at a specific strike price at any time before the expiration date of that contract. Again, the long call buyer has the right to buy the stock. The long put buyer or put holder has the right to sell 100 shares of the underlying stock at that strike price at any time before the expiration date of that contract. So option buyers, option holders have rights. The seller of an option or writer of the option, in this case we'll say a call option, they are obligated to sell 100 shares of the stock at the strike price in question at any time before the expiration date of that contract. They can be assigned early, they can be assigned late, they can be assigned on the last trading day, expiration day of this contract. A call seller has the obligation to deliver 100 shares of stock. A put seller, on the other hand, has the obligation to buy 100 shares of the underlying stock or ETF at that strike price anytime they receive an assignment notice. That assignment notice can come on any business day before expiration or at the expiration of that contract. To review equity call options, the equity call buyer or holder has the right to buy 100 shares of the stock. Sometimes they are called or known as long that call option. They can also be known as the option holder. The flip side, an equity call seller has the obligation to sell or deliver 100 shares of underlying stock at that strike price. They are also known as being short that call option. They can also be known as an option writer. Equity put options. An equity put option buyer or owner has the right to sell the underlying stock. They are known as option holders. They can also refer to themselves as being long the put contract. Equity option holders have rights. On the other hand, an equity put seller has the obligation to buy the underlying stock if they are assigned an exercise notice. If they are assigned an exercise notice, they have to buy the underlying stock as a put seller. They are also known as being short the contract and as a put writer. Important terms of an options contract include the fact that an option contract has an expiration date. They expire. Equity options contracts have standardized terms that include the underlying stock. They also include the unit of trade, typically 100 shares or 100 of the ETF units. We also have a strike price, which is sometimes referred to as the exercise price, and we have an expiration date. These are all specific terms of an options contract. Now, these components are expressed in this brief statement here. We have XYZ December 45 call at 5:50. The underlying, which is typically 100 shares of the stock or ETF, in this case, the underlying security is XYZ. It is 100 shares of XYZ. The strike price, also expressed in this brief term up here on the top of the slide, that is the price at which the underlying stock may be bought or sold. In this case, it's a call option, and it is a $45 strike price call. The expiration date, that's self-evident. It's a December expiration. Just a note, many option contracts will include the specific expiration date for this contract. So it would be December 17th, for example. The premium, that's the per share price that the underlying security may be bought or sold. And typically, the premium multiplier is equal to the same number of shares that are in the contract. And in this case, 5.50 times 100, or that would be $550 per contract.
Now, Bill was talking about expiration dates, talking about December expiry, for example. Now, what does that mean? Well, option contracts, as we had mentioned, option contracts aren't forever. As most contracts aren't, right? They have an expiration date. In this particular case, options have expiration dates as well, and what those expiration dates tell us is that the option contract must be exercised at or prior to that date before it expires, before it goes extinct. Now, again, we had spoken about how buyers have rights. In the case of a call, they have the right to buy 100 shares of the underlying, typically, or in the case of a put, the right to sell 100 shares of the underlying, again, at the strike price and that is if he or she exercises that long contract. Now, exercise, when we talk about that, what we're really talking about is making the terms of the contract, enforcing the terms of the contract, calling that contract due. So by exercising your contract, if you're a long call, for example, you're going to be paying the strike price times $100 times the number of contracts that you have. That money will be debited from your account. In return, you will receive what we call the deliverable. You will receive 100 shares of the stock. You will receive cash if it has a cash deliverable like an index, and we'll get into that a little bit later. But you will receive the deliverable. You pay the money, and you receive the stock. A lot of people say, for example, a $45 call, if the stock is trading $50, you pay $4,500, you receive 100 shares of stock. In effect, you're getting the stock for $45 a share. Now, to exercise, the buyer will issue an exercise notice to their brokerage firm. Many brokerage firms have a policy, what we call X by X, or exercise by exception. You'll need to check with your broker to make sure to see if they have this policy. Most of them do. But what the policy tells us is that if your option is in the money by at least 1 penny, that option will automatically be exercised unless specifically told not to by the option holder. And again, only option buyers may exercise. We talked about buyers have rights. Well, this is the right. They have the right to exercise. Again, the option buyers will exercise their contract if it is what we call in the money by at least a penny, and that should be done automatically. Now, what is it on the other side? If you are an option seller, you are obligated. Again, we talked about that. And what happens with option sellers, they receive an assignment notice. What that assignment notice means is that they are now required to, and again, that phrase or that word required, they are obligated. They don't have a choice. They are required to sell, in the case of a call, or buy, in the case of a put, 100 shares of stock at the strike price, and they will receive an assignment notice from their firm letting them know that they have been assigned. And the way that assignment and exercise works, it's a completely random process. If I'm a call holder and my option finishes in the money, I will either choose to exercise my contract or it will automatically get exercised. That exercise notice will go to my broker, who will then send it to his or her clearing firm. That clearing firm will then in turn notify the OCC, the Options Clearing Corporation. This is what they're all about. They facilitate the exercise and assignment of option contracts. That exercise notice will then turn into an assignment notice where the OCC will then randomly assign a clearing firm that has a brokerage firm that has a client that has a short position in that particular security. So I exercise my call. Somebody else, not the person that I did my trade with necessarily, some other random person will get assigned on their option. And in the case of a call, they will be required to sell me 100 shares of stock at that strike price. Now, we talked about indexes versus equities and things like that. Bill had mentioned physical settlement. So we're going to talk about exercise and settlement style. Physical settlement is where the option results, the exercised option results in the receipt or delivery of physical securities. Stock. Stock is credited to and cash debited from your account, as you can see. Physical delivery equates to stock. Cash delivery, in the case of an indice or an index, which I mentioned earlier, that's where you'll receive the difference or pay out the difference of the stock price, or let me rephrase that, of the index settlement price versus your strike price. It's settled in cash. There is no stock that trades hands. There is no stock that goes in or out of your account. Now, in terms of exercise styles, there's two. There's American and European. American exercise style, can it be exercised at any time during the life of the option? And therefore, the short seller, the call seller, or the put seller can be assigned at any time during the life of the option. Now, typically what we see, again, exercise is only for buyers. So that leaves us buying a call and buying a put. Now, when it comes to buying a call, that's really the only time that we see early exercise. And there's something called a dividend play. And what a dividend play is, and again, that's typically the only time that we see early exercise, is when the amount of the dividend exceeds the time value or the extrinsic value of the option. And again, we'll get into intrinsic versus extrinsic situations, values in our next section here. But dividend plays is really the only time that we see an option, a long call, get exercised early. When it comes to European options, there is no early exercise. There is no early assignment. Exercise can only take place at expiration. Now, we've talked a lot about in the money and intrinsic value and such. There's terms that we refer to called in the money, at the money, and out of the money, abbreviated here ITM, ATM, and OTM. So in the money options are options that have an inherent value. It's in terms of a call, it's the difference between the strike price and the stock price. Let me rephrase that. In terms of options, it's the difference between the strike price and the stock price, regardless of call or put. In the case of a call, intrinsic value occurs when the strike price is below the stock price. That's what we call in the money. And the reason being is if the stock price is $50, as you can see here on the example, and we owned a $45 call, in effect, we're buying the stock for $45 when it's trading $50. We're in the money. At the money is where the strike price is the same as the stock price, where out of the money is when the strike price is above the stock price. And look at a way to look at out of the money is if I have a $55 call and the stock is trading $50, well, I certainly don't want to buy the stock for $55 when I can go out into the market and purchase it for $50. That would be an out of the money transaction, and if you're looking to trade options to make money, that's something that you want to do as seldom as possible, exercising your out-of-the-money call, right? When it comes to puts, it's the opposite. With puts, the strike price needs to be above the stock price in order to be in the money. You want to sell your stock above where it's currently trading. So puts are above the stock price to be in the money. They are out of the money if they are below the stock price. And just like with calls, they are at the money if the stock price equals, if they are both the same. Now, option premiums, there's a couple different things that come into play. Again, as Bill had mentioned, buyers pay a premium for the right for their option. That premium that they pay is non-refundable. That premium is also the extent of their loss. That premium is the most money they can lose. When it comes to options, if you're a buyer of an option, whether it's a buyer of a put, a call, a spread, a condor, what have you, the most money that you can lose is what you put into it. Okay? As a seller, the premium that you receive, you keep it whether you get assigned or not. All right? That is the extent of your profit. The most money you can make as a seller is what you receive when selling the option. And again, as Bill had mentioned earlier, premiums are quoted typically on a per-share basis times a multiplier of 100. So a $3 premium equals a $300 real dollar value. And of course, as we had mentioned earlier on the disclaimers, we're not including commissions, taxes, fees, etc. Now, I've made mention a lot about intrinsic value. Intrinsic value, and there's also another concept called time value, or what we would call extrinsic. Okay. Intrinsic value, as we had mentioned, is the in-the-money amount of the option, the inherent value of the option. That's what we call the intrinsic value. Anything over and above that in terms of the option premium is called time value. And that time value, it decays, it gets less as options near expiration. Time value is made up of several different criteria. Number one being time until expiration, two being volatility, and then 3 and 4, any interest rates or dividends, something like that. But a main component of time value is time. And the less time there is, the less value that option has. And as you can see by that last comment, at expiration, options are only worth their intrinsic value. There is no time value remaining. So let's look at intrinsic versus time value. Let's break it down. Again, in-the-money calls and puts have intrinsic value, and they may or may not have time value, depending on how close they are to expiration. At-the-money calls and puts, as well as out-of-the-money calls and puts, have absolutely no intrinsic value and are all time value. And again, that time value decays. There's a concept called options Greeks. And some of the Greeks are delta, gamma, vega. Theta is another option Greek. And theta measures the decay, the rate of change of that option, the decay of the value of that option as the days go by. And that's slightly a more intermediate concept that we discuss a little bit more in depth on our optionseducation.org website. When we get into option pricing a little bit later in the year, we'll cover that as well. So in terms of intrinsic versus time value, let's look at an example. XYZ stock trading $53 a share. XYZ, the January 50 call, trading $5.20. Now that option, that call is in the money by $3. We know that because the stock is trading 53. We have a $50 call. That call is below the stock price. That gives us an intrinsic or in the money value of $3. The option premium is $5.20. So anything over and above that $3, again, is what we call time value. Now in the lower right-hand corner, there's another example for a $60 call, assuming that same $53 stock price. And with the option trading 210, what's the intrinsic value? And what's the time value? Well, the $60 call is above the stock price, so we know that there is no intrinsic value. Therefore, the $2.10 premium must entirely be time value. And let's look at another example in a polling question. If I buy an XYZ March double call, March 55 call, on the trading floor, we refer to them as doubles or double nickels. So if I buy an XYZ March double call for $3.50 with the stock value at 57.5, then my option is in the money with an intrinsic value of 3.5 and no time value. Or is my option out of the money with no intrinsic value and $3.50 of time value? Or is my option in the money with intrinsic value of 2.5 and $1 worth of time value? Or is my option out of the money with $3.50 of intrinsic value and no time value? What do you think? Go ahead and make your choice and click submit, and we'll take a look and make sure that everybody is understanding these concepts. Go ahead and make your choice there. I don't see any responses coming back. I want to make sure that everybody is on the same page. Well, let's take a look. Oh, excellent. There they are. Well, it looks like everyone understands us. I'm glad to see that. So we got everyone is saying that we've got $2.50 of intrinsic value and $1 of time value. Again, the March double call, stock 57.5 cents, $2.50 intrinsic, $1 of time value. That's excellent. Very, very glad to see that. That means I've done my job, or you attendees are just super smart, or maybe a little bit of both. Bill is going to take us through some more complex concepts. Bill's going to tell us about buying calls and such. Bill?
Thank you, Mark. Why would anybody buy a call option? Well, the main reason you would buy a call is you are bullish on a particular stock. And one way to benefit from a bullish forecast, a correct bullish forecast in rising prices, is to buy a call option. One of the attractive features of call options is when we buy this call option, we have a limited small cash outlay. It's a lot easier to buy, or it's obviously cheaper to buy, a $3.30 call option with a strike price of $50. Okay, we're paying $330 in that respect versus buying 100 shares of stock at $50. We're talking about $5,000. Another benefit is our risk is limited to what we paid for the call option. And this is buying calls is an alternative to buying the stock outright, and that brings up one of the more attractive features of an options contract, and that is leverage. Leverage, in this case, means a small amount of money is controlling a larger, more expensive asset. But you have to remember, leverage cuts both ways. You can make a large amount of money in a short period of time. The flip side is you can lose, as a call option buyer, you can lose your entire investment, and it could be in a very short period of time. Remember, the call buyer has the right to buy the underlying stock. They have the right but not the obligation to buy that stock, and it's, of course, 100 shares of stock at the strike price at any time up until the expiration of that contract. And remember, as the call buyer pays the premium, I should say they pay that premium for the right. This is a profit loss diagram for a call buyer. This is, as our attendees know, this is the classic hockey stick P&L profile profit and loss diagram for a long call buyer. You'll notice on the left-hand side of that diagram, we have the limited risk, the fixed amount that we paid for this call option. And as the stock rises in value, you'll notice you have unlimited upside profit potential. Again, profit upside, we have unlimited upside potential. And if the stock were to decline in price, we are limited, our risk is limited to the original premium that we paid. Our next section is buying puts. Why would anybody buy a put? Well, in this case, we expect the investor is bearish on a particular stock, and they are looking to profit or benefit from the falling prices. Again, since we're buying a put option, we have a small cash outlay that controls a larger asset, the right to sell this asset, and we have a limited predefined risk. We know the most we can lose for our option purchase is what we paid for the option. And one of the more compelling reasons to buy a put is that it is an alternative to selling stock short. When an investor sells stock short, they are selling stock that they do not own, and they have unlimited risk to the upside. As a put buyer, we have, again, a predefined risk. Remember, the put buyer has the right, but not the obligation, to sell the underlying stock, which is, of course, 100 shares of stock at the strike price up till and including the expiration day of that contract. For this right, the put buyer pays that premium. Here's our profit loss diagram for a put buyer. As you'll notice in the diagram, as the underlying security declines, you have substantial profit potential. On the other hand, if the stock rises in price, as a put buyer, you have the fixed limited risk, which is, again, that risk is limited to the premium that you paid for the options contract. Selling calls. Well, as the slide asks us, why would we sell calls? Well, I expect the investor is neutral to bearish on a particular stock, and they forecast little likelihood of an increase in price. The investor is looking to benefit from steady or declining option prices, and the investor is almost certainly looking to earn income by selling option premium. The call seller has the obligation to sell that underlying stock or ETF. They are on the hook to deliver 100 shares of stock at the strike price at any time until expiration, if and when they receive an assignment notice. For undertaking this obligation, the call seller receives premium. We should also note that an uncovered or naked call seller or short call is considered to be the highest level of options risk. Why is it the highest level? Because, as we mentioned earlier, you have unlimited risk to the upside. Speaking of unlimited risk, the call seller in this diagram, the naked call seller, has a limited profit potential. Not limited risk, they have limited profit potential, and their upside risk is correctly defined as unlimited. So again, the risk weigh the benefits or the risk and reward of a call seller. The option trader must factor in the premium I received for selling this call short, is that sufficient compensation for the unlimited risk that I'm taking on? This slide is a diagram of long calls versus short calls. Okay, the long call owner has the right to buy the stock. Call seller, the short call seller, has the obligation to potentially sell the stock. The long call holder can buy the stock if they choose to exercise the contract. The call seller must sell the stock if they are assigned an exercise notice. They don't have a choice. Long call holder typically profits if the stock rises in value. If the stock declines, we'd expect that long call option to decline in value as well. Short calls, they profit if the stock falls. That call option we would expect would start to lose value. If the stock rises, that call option will increase in value. They sold it at a lower price, so again, they are losing in that scenario when the stock rises. The long call holder can lose, that options contract can lose its extrinsic or time value as the calendar marches on. As time marches on, we can lose value as time passes. The call seller, the short call seller, that call option loses value as time passes, and that could be a potential profit. We're talking about selling puts now. Why would an investor sell puts? Well, they are neutral to bullish on that stock. They see little likelihood of that stock declining any more in price. If they forecast steady or rising prices, this put option should start declining in value, and they are looking to generate income from selling those options and collecting the premium. The put seller, in return for receiving this premium, the put seller has the obligation to buy the underlying stock. Remember, this is a bullish strategy. They have the obligation to buy the underlying stock. It's, again, 100 shares at the strike price up till and including the expiration date. An uncovered or naked short put writer is generally considered to be the second highest level of risk. Here's our profit loss diagram. We have, again, we want to make a on-the-fly edit here. We have substantial risk, but it is limited by the fact that the stock cannot drop below zero. As the stock rises in price, the put option should decline in value. And again, your profit is limited to the premium you received when you originally sold this put option. Put sellers might also have the objective of acquiring the stock in question. So if the stock were to decline and they were to be assigned on that put option, they're willing to buy that stock at the strike price. So again, it's a very bullish strategy. Let's compare long puts versus short puts. The holder or buyer of a put option owns the right to sell the stock. The seller of the put option has the obligation to potentially buy the stock. Remember, option holders have rights, sellers have obligations. The long put holder can sell that stock if they choose to exercise or enforce the terms of the contract. The short put seller must buy the stock if they are assigned. Okay, there's no choice. They don't have a choice. They have to buy the stock. They will pay 100 times the strike and take delivery of 100 shares of the stock. The long put holder profits if the stock falls. If the stock rises, that put option will become less valuable and might, in fact, expire worthless. The short put seller profits if the stock rises. As the stock rises, that put option declines in price. They might possibly buy it back at a lower price than they originally sold it for. If the stock, however, falls in price, that put option will gain in value. The long put holder can expect that as time passes on, this options contract will decline in value so that at expiration it will only be worth its intrinsic value amount. A short put seller benefits from the passing of time. As time passes on, this contract will lose any and all time value, and this could lead to potential profits.
Let's look at our next polling question here. If approved to trade by my broker, options can help me acquire stock, generate income, reduce risk, offer flexibility, or all of the above and much, much more. If approved to trade by my broker, options can help me what? And it looks like we've got some responses coming back. And again, either Bill and I are absolutely doing our job 100% to our capabilities, or you are the smartest crowd out there. All of the above and much, much more. Well done, ladies and gentlemen. So we've got a few minutes left. And Alex, I know that I had seen that there were some questions coming across the screen, which I'm glad because, again, next week's presentation is going to be that new format where your questions are going to determine what that presentation encompasses. So I saw some of the questions coming across, and I know we've got a lot of material for next week. Let's get to some of those questions now and get to answering them. Alex, what do you have for us?
Hi, Mark. Yes, we do have a few questions today, but I'd like to remind our listeners that if you have further questions about the concepts we discussed today or the tools on the OIC website, or if we just weren't able to get to the questions you submitted, you can contact our investor services team at options@theocc.com. That is options with an S @theocc.com. They're ready to help answer questions about option strategies or position. And Mark, I do have a pretty good question here for you. I just completed my first trade. I think that Apple is going to rise, so I buy 2 Apple March 125 calls for $1. What will happen at expiration if I'm right, and what will happen if I'm wrong?
Okay, that is an excellent question. And So let's see, we buy Apple, we buy the March 125 call, as you had said. Well, at expiration, one of a couple things are going to happen. Apple's going to be up or Apple's going to be down. Now, the 125 call, and you paid $1 for it, so that's giving you the right to buy Apple stock for $125. Now, it's costing you $1 for that right. So in order for you to make money at expiration, Apple needs to be above that $126 amount, that $126, that's going to be your break-even point. If Apple is above $126, then you would, my assumption, we can't provide advice, and as my partner Bill says, we would never presume to tell you what to do. But if Apple was above 126, or even if Apple was above 125 for that matter, that contract would be automatically exercised. You would pay the strike price times 100, and in return you would receive 100 shares of Apple stock. If Apple is below 125, then it doesn't make sense to buy that stock for $125 when, for example, you can go in the market and buy it for $120 if you wanted to. So what would happen is that option premium, that $1 that you paid for that call, would expire, and that would be the extent of your loss, that $1. Now, that's not to say that if the stock is moving somewhere between, up or down or even staying the same between now and expiration, you can certainly turn around and sell that option back to the market if it's profitable. Let's say you paid $1 for the option and Apple rallies to, say, $128. Well, now that option is worth $3 and change. Maybe it's worth $3.50. But now you can turn around and sell that $1 option for $3.50. You keep that $2.50 profit, the difference between what you paid and what you sold it for. That's your profit, and now you have no risk. So there's a couple things that you can do. If it goes up, you can exercise. If it goes down, typically you'll lose your investment. But again, your investment is limited to what you put into it. Or, depending on what Apple does, you can sell the option back to the marketplace, hopefully for a profit.
Mark, I just wanted to mention your scenario there where we sell the options contract back into the marketplace. You and I were just looking at some statistics earlier this week, late last week. The vast majority of option positions that are established in the options marketplace are closed out in the options marketplace. So if I buy to open an Apple 125 call option, at some point in the future, before expiration, I'm going to sell that March 125 call option back into the marketplace. I'm going to be selling to close my previously bought to open position, and I'm netting the difference between what I paid for it and what I sold it for. Vast majority, I would say almost 70% of the time, certainly 66% of the time, options positions are closed out in the options marketplace rather than expiring worthless or being exercised. I'm sorry, back to you, Alex.
You know what, you're right. That's an excellent point. Thank you. Definitely thank you for bringing that up.
I do have another question, this one directed for Bill. I'm bearish on a stock. How do I choose between a long put strategy and a short call strategy?
Well, that's an excellent question, and I would think that the investor who is considering, or the bearish investor who's considering either buying a put or selling an uncovered call would want to carefully weigh the risk and reward of the two strategies. As we mentioned earlier, the short call seller has unlimited upside risk, whereas the long put buyer, if the stock goes from 100 to 150 and they bought a $90 put, they're not going to lose. They're only going to lose what they paid for that put option. So many times the answer when choosing between two bullish strategies or two bearish strategies, many times the answer lies in weighing the risk to reward.
Great. And then, Mark, you mentioned dividends and early exercise. Can you expand upon that?
Yeah, certainly. So, we had talked about with the long call and American exercise options. Again, American exercise options are options that you can exercise at any time. And don't be fooled. I did see a question that came across earlier. The origin of the company is irrelevant to the settlement style. There was a question that came across. The Fiat Chrysler is an Italian company, and that be a European exercise. That is in no way indicative of the exercise style. It's simply whether or not they allow early exercise or not. So in this case, with the dividend play, so American exercise equities and ETFs, which the majority of them are, we talked about the intrinsic value versus extrinsic or time value. When you exercise your option, all right, and we had talked about how at expiration there is no time value. So when you exercise your option, you're exercising it for the intrinsic value only. But if you exercise the option early, you may be foregoing that time value component that the option has. Now, with the dividend play, let's say the time value of the option is, off the top of my head, let's say it's 75 cents. So if I were to exercise my call early, I would be foregoing that 75 cents per option contract, or in reality $75, right, per option contract. But I would be foregoing that 75 cents by exercising my contract early. But by exercising my contract early, I now become a shareholder. I now take delivery of that stock. And if that stock pays a dividend of more than 75 cents, let's say it pays $1 dividend, I'm actually profiting an additional quarter by exercising that stock early rather than just letting it expire. And that's what we call a dividend play, where you'll typically see where there's a dividend coming up. And in order to take advantage of that dividend, again, the only people that receive dividends are shareholders. So in order to receive that dividend, I need to be a shareholder. I need to exercise my contract prior to what they call that ex-dividend date or ex-div date. That will allow me to become a shareholder, get that dividend paid to me, and as long as it exceeds the value of that time value, your broker would say it makes sense to exercise that option. That's what we call a dividend play. Alex?
Great. Thank you for explaining that a little bit further. Bill, I have a question for you. If I buy a call option and the stock trades higher, do I have to exercise the call to collect my profit?
Oh, that's an excellent question, and it kind of goes back to the point that Mark had made earlier in our first question. We do know that in calculating our break-even point for a long call, we add the premium paid to our long strike price. This is referred to as the break-even point, or BEP. We should further add that this is the break-even point at expiration, because at expiration, a call option, well, options have zero time value. They are only worth their intrinsic value. So the answer to the visitor's question is, do you have to exercise that call to collect your profit? Absolutely not. What most traders do is enter into a closing transaction. They sell to close their previously bought to open or buy to open call option. And when they sell that to close, the difference between what they pay for it and what they sell it for is their profit or loss. While it's extremely helpful for the stock to trade above your break-even point, it's not necessary for that to occur for you to be profitable. If the stock appears to be heading toward that strike price, if it's moving higher but has not gone above the strike, you still may have a profitable trade presented to you. It really depends on the market quotes. And again, you would simply profit from that by selling the contract back into the marketplace.
Great. Thank you, Bill. Ladies and gentlemen, thank you for your time today. While we weren't able to get to all your questions, we have our investor services desk ready to help. Feel free to reach out to them at options@theocc.com. Again, that's options with an S at theocc.com. Additionally, our webinars are available on the OIC YouTube channel, so you can review a number of option strategies and concepts at your own pace. And don't forget to like us on Facebook and follow us on Twitter. Many of you asked about further education. Please visit optionseducation.org, the OIC's website, and see the Getting Started section for further reading. And of course, make sure to check out optionseducation.org for a list of our upcoming webinars. Be sure to tune in next Tuesday for our Q&A style options webinar called Your Options Questions Answered. Thank you again for attending, and we hope to see you again next week. And be sure to come with questions.